Welcome to Global News. We are back, and tonight we begin our soul-searching deep dive.
$5 billion. Let's just let that sink in for a moment.
It's a hard number to even process.
It really is. As of this morning, January 23, 2026, the on-paper valuation of the Trump family's known crypto holdings is sitting at just about $5 billion.
On paper. And that is the most important qualifier in this entire conversation. That's the thread we really, really need to pull on today.
Right, because if you're just, scrolling your feed, you're seeing headlines about the protocol's revenue, you see these stories about the fees it's generating.
Hundreds of millions of dollars. And that's not nothing, of course. It's a huge amount of money.
But it's also, and this is the core of our deep dive today, it's the wrong story. People are fixated on the cash flow. But today, we're going to ignore that noise. We're going to look at the signal.
We're going forensic. We're essentially conducting an accounting investigation based on this new report that's been circulating, the one they're calling the Sovereign Chain.
It sounds like a Robert Ludlum novel, doesn't it? The Sovereign Chain.
It does, but it's actually a very precise, almost clinical description of the financial architecture that's being built. What we're witnessing is this collision, this fusion of high finance and raw statecraft.
This isn't just, some celebrity putting their name on a meme coin.
No, not at all. This
Right.
is the installation of a parallel financial system, a system that sits right alongside the Federal Reserve, but with let's say, a very different mandate.
So yeah, this is the mission for today. We're going to analyze the source material, primarily that dense forensic report, to understand how this $5 billion machine actually works.
And the central hypothesis, the argument that the report puts forward, was pretty chilling. It's that the media is obsessed with the fees. But the real story, the one that should keep you up at night, is the unreleased equity.
That $5 billion.
That $5 billion. The report's core argument is that the project's primary value isn't the business it does day to day. It's the strategic management of this massive block of assets in a market that has been completely and totally captured by its own regulators.
Captured by the very people who stand to benefit. It's got a real Big Short vibe today, I have to say.
It does. We're not looking at the shiny exterior. We're looking at the plumbing. We're trying to figure out where the new pipes have been installed.
And who they're diverting the water to. Okay, so to really get this, we have to rewind. To understand where we are in January 2026, you have to go back. Because this whole scenario would have been unthinkable just a few years ago.
Absolutely impossible. I mean, if you pull up the transcripts from, say, 2021, the entire narrative is inverted.
Completely. The former president was on record multiple times calling crypto a scam.
And not just a scam, but a direct threat. A threat to the supremacy of the U.S. dollar. He was a greenback hardliner, full stop.
I remember it clearly. It was this very kind of get off my lawn attitude towards Bitcoin and anything like it. The dollar was the only game in town.
But then you fast forward to the 2024 campaign and into the first year of the new administration, and the script doesn't just change.
It does a complete 180. Why? What was the catalyst for such a fundamental shift in ideology?
Well, it wasn't ideology, it was data. Specifically, it was fundraising data. It was the slow realization of a new, incredibly powerful monetization engine.
And the proof of concept, according to the report we're looking at, was the Trump digital trading cards.
The NFTs. The now infamous JPEGs of him as a superhero, an astronaut, a cowboy.
We all kind of laughed at them at the time, didn't we? The media framed it as this sort of kitschy cash grab.
And it was a cash grab. It generated millions. But underneath that, it was also a clinical financial experiment. They weren't just testing if people would buy digital pictures. They were testing a specific market mechanism. The report calls it the lock.
Okay, walk me through that, because my understanding of NFTs, at least back then, was you'd buy it and then you could immediately try and flip it on a marketplace like OpenSea.
That's the standard model, yes. It encourages high velocity, lots of trading. But these contracts were written differently. They had built-in restrictions on secondary market trading for set periods of time.
So you couldn't just dump it.
You couldn't. It forced the buyers to become holders. It proved to the family, and this is the crucial part, that they could manufacture digital scarcity and, more importantly, control the velocity of the asset. They could stop a market from crashing.
So it wasn't about the art. It was a stress test for the financial plumbing.
It was a beta test for market mechanics. It gave them the data they needed to say, okay, we can control the float of a digital asset. And that confidence, that's what led to the evolution from these simple arm's-length licensing deals.
Like Trump steaks or Trump vodka.
Exactly, where they just slap a label on a product someone else makes. This was a pivot to a direct equity venture. This is World Liberty Financial.
And that's a key distinction the report makes.
Okay.
This isn't licensing. Donald Jr., Eric, even Barron Trump, they're listed on the website. Co-founders, Web3 ambassadors.
Right, and that direct family involvement creates something the report calls a sovereign premium.
A sovereign premium. Explain that.
Well, think about it from an investor's point of view. If you buy a token for some random DeFi protocol, you're betting on a few anonymous developers and their code. But here, who are you betting on?
You're betting on the United States executive branch.
You are purchasing a perceived, almost explicit alignment with the future of U.S. financial policy. It creates what they call a regulatory moat that no other crypto project on the planet can cross. You can't compete with it.
It's like buying shares in a company where the CEO also happens to write all the laws that govern the industry.
That is the argument, in a nutshell. And it's all laid out not in a white paper, which is what you typically see,
Right, the tech document.
but in something they called a gold paper.
Yeah, the branding is not exactly subtle, is it?
No, it is not. But the substance is what's fascinating. A typical crypto white paper. It's all about cryptography, consensus mechanisms, how the tech works. The gold paper barely mentions the tech.
So what does it talk about?
Liability. Corporate structuring. It focuses almost entirely on how the liability works. And at the center of that is a specific entity, DT Marks DeFi LLC.
Okay, that's the holding company, right? The Delaware one.
That's the one. Delaware domiciled, for all the usual reasons. And this gold paper, it performs this very specific, very clever legal gymnastic routine.
Which is...
It explicitly states that while the Trump family, through that LLC, holds the economic rights to the protocol's profits, they are not officers, directors, or employees of the company.
Wait, hold on a second. How can that be? They're on the website as co-founders. They're tweeting about it every day as Web3 ambassadors. How can you be a founder but not an officer?
Well, that's the magic trick, isn't it? In the eyes of their lawyers, and presumably in the eyes of the current SEC, being a Web3 ambassador is a promotional role. It's marketing. It's not an operational role.
That feels like a very, very thin line, a distinction without a difference.
In the court of public opinion, maybe. But in a court of law, it's a massive difference. It's a firewall. The argument becomes, sure, send the profit checks to DT Marks DeFi LLC, but if the protocol gets hacked, if the code fails, don't sue the president. He's just an ambassador.
So they've managed to capture all the financial upside of being a founder, but with the liability profile of, like, a paid celebrity spokesperson.
You've nailed it. It shields the president from direct operational liability while ensuring that 100% of the economic benefit flows directly to his entity. It's a masterclass in corporate structuring.
And to really understand the scale here, the report breaks down the anatomy of this machine. And I think this is where a lot of people get lost, even people who follow this space.
Oh, definitely. The inquiries we've seen are constantly confusing the two different tokens involved.
Right. You have USD1 and you have WLFI. They're not the same thing.
Not at all. Let's start with USD1. That's the stable coin. It's meant to be the boring, stable part of the ecosystem.
Pegged 1-to-1 with the US dollar.
Exactly. Backed by cash, by U.S. treasuries. It's custodied by a regulated entity, BitGo. It's the operational engine. When you use the World Liberty Financial platform to lend or borrow or trade, you're doing it with USD1. It's the utility token.
Simple enough. Okay, so what is WLFI?
WLFI is the governance token. WLFI is where the value, the speculative wealth, is stored. There's a fixed supply, 100 billion tokens. It doesn't track the dollar. Its price moves based on the perceived value and future prospects of the entire protocol.
And this is where the report draws that sharp line between fees and equity.
This is the pocket change versus generational wealth argument we started with. It's the absolute core of the financial structure.
So let's talk fees, the pocket change.
Okay, so under the agreement laid out in the gold paper, DT Marks DeFi LLC is entitled to 75% of all net protocol revenues.
75%. That seems incredibly high. Most founder takes are, what, 20, maybe 25%?
It is astronomical, and the numbers are huge. In 2025, the forensic report estimates the total earnings were around $390 million.
So the Trump entity's share of that would be?
Just under $300 million, roughly $292.5 million.
Okay. Nearly $300 million a year in cash flow. I have to stop you there. How is that pocket change? That is an immense amount of money.
It is an immense amount of money to you and me. It's a fortune. But in the context of this $5 billion valuation, in the world of high finance they're operating in, it's the dividend. It's the operating budget. It pays for the lawyers. It keeps the lights on at Mar-a-Lago. It funds the political machine. It is not the main event.
The main event is the equity, the $5 billion.
The main event is the equity, the structure. From day one, at the genesis of the project, DT Mark DeFi LLC was allocated 22.5 billion WLFI tokens.
Which is 22.5% of the total supply.
Correct.
How does that stack up against, other major crypto projects? Is that a normal allocation for insiders?
It's on the very high end. For comparison, the Ethereum Foundation and other early insiders got about 16% of the initial supply of ETH. So this is significantly higher. But the key isn't just the percentage, it's what that block of tokens represents.
And what is that?
The report calls it a call option on the future of the U.S. financial system.
A call option. So an instrument that becomes incredibly valuable if the underlying asset, in this case, the U.S. financial system, moves in a very specific direction.
Exactly. The value isn't in the $300 million a year. It's in the potential for those 22.5 billion tokens to be worth 10, 20, $50 billion if certain political and regulatory events unfold correctly.
Which brings us to how they created this $5 billion valuation in the first place.
Yeah.
The report calls the mechanism low float, high FDV.
Yes. FDV stands for fully diluted valuation, and this concept is the engine room of so many crypto valuations, but this is an extreme example.
Okay, so break it down for us. Assume we don't know what that means.
Okay, imagine you're starting a company, and you create 100 shares. But instead of selling all 100, you keep 99 of them locked in a safe. You only let the public trade one single share.
Just one. So the publicly available supply is tiny. You're choking it.
You're suffocating it. Now, let's say there's a lot of hype around your company. A lot of people want that one share. The price gets bid up and up and up. That one share starts trading for, say, $100.
Okay, so the market price for a share is $100.
Exactly. Now, what do? You point to the 99 shares you have locked in your safe and you say, look, the market price is $100 a share. I have 99 shares, therefore my holdings are worth $9,900, and my company's total valuation is $10,000.
But if you actually tried to sell those 99 shares on the open market,
poof, the price would instantly crash to zero. There isn't $10,000 of actual money wanting to buy your shares. There's only enough money to trade that one share back and forth. That is the essence of low float, high FDV. It's a valuation mirage.
And the argument is that is precisely what is happening with the WLFI token.
It's a textbook case. The total supply is 100 billion tokens. As of today, the market price is hovering around 22 cents.
So you take the family's allocation, 22.5 billion tokens, you multiply it by 22 cents.
And you get your headline number, roughly $4.95 billion.
But it's an illusion of liquidity.
It's pure paper wealth. If they tried to click sell on that $4.95 billion position today, the market couldn't absorb a tiny fraction of it before the price collapsed. But, and this is a really critical point the report makes, that high paper valuation serves a very important strategic purpose.
Beyond just making them look incredibly rich on paper.
Much more than that. It provides what's called collateral weight. It gives the project an aura of financial legitimacy. It's the same playbook used by FTX with their FTT token, or by Solana-related projects like Serum back in the 2020-2021 bull market.
You create a massive multi-billion-dollar valuation on paper, even if it's illiquid.
And suddenly you can walk into a meeting with Goldman Sachs or BlackRock and say, we are a $20 billion protocol. It changes the conversation, allows you to borrow against that valuation. It makes you look like a legitimate financial institution, even if the actual liquid capital in the system is just a fraction of that.
So how do they maintain this illusion? How do they keep the float so low? The report talks about the lockbox.
Right. It's not just the founders' tokens that are locked. At the public launch, only 20% of the tokens allocated to the public were actually unlocked and tradable.
Only 20%.
Yes. The remaining 80% of the public's tokens, plus the entire 22.5 billion founder allocation, are all held in this lockbox. It's a series of smart contracts that prevent the tokens from being sold. It's an artificial, programmatic restriction of supply designed to do one thing: maintain a high price per token.
So we have this $5 billion asset that's essentially frozen. It's stuck.
Yeah.
Which brings us back to that central question. How do you get it out? How do you turn that paper wealth into cold, hard cash without destroying the very valuation you've created?
That is the multi-billion-dollar question. And the answer, according to the Sovereign Chain report, is that you don't rely on the market. You don't hope for demand. You use the power of the state to manufacture demand.
You engage in regulatory capture?
On an unprecedented scale. You have to force capital into your system. And the primary tool for that, the legislative battering ram, is the 2025 law known as the Genius Act.
The Gold Paper, the Genius Act?
Yeah.
They really have a flair for branding.
Subtlety is not the defining characteristic here. The Genius Act was signed into law by President Trump in mid-2025. On the surface, it was pitched as a bill to provide much-needed regulatory clarity for the stablecoin industry.
Which, to be fair, is something the crypto industry had been begging for years.
For a decade. And that's what makes it so, genius. It was presented as a solution. But the devil, as always, is in the details of the legislation.
What did it actually do?
It established something called a National Trust Charter for stablecoin issuers, and it effectively said if you are an institution, a U.S. bank, a pension fund, and you want to hold or transact with digital dollars, they must be from a provider that holds this National Trust Charter.
Okay, and what are the requirements to get that charter?
Well, funny you should ask. The requirements are written in such a way that they effectively ban any major offshore competitor. They require all reserves to be held onshore in U.S. banks. They demand specific, real-time audit trails. They create a compliance burden that existing giants, like Tether, which operates in a sort of gray market jurisdiction, simply cannot meet.
So it's not a framework for competition. It's a targeted strike designed to eliminate the competition.
It's a regulatory moat dug with a legislative shovel. If you are the manager of a multi-billion-dollar hedge fund in 2026 and you want crypto exposure, the Genius Act makes it legally impossible, or at least incredibly risky, for you to use an offshore stablecoin like Tether. You must use a charter-compliant coin.
And wouldn't you know it, the first and largest stablecoin to seek and receive a national trust charter happens to be
USD1. The very same stablecoin whose fee structure funnels 75% of its profits directly into DT Mark's DII LLC. It's a forced migration of institutional capital. The government literally paves a superhighway, and that highway has only one off-ramp, which leads directly to the family's private pool booth.
And you can see the flywheel effect immediately. If the law forces trillions of dollars of institutional capital to flow into USD1,
then the total value locked, or TVL, in the world Liberty financial ecosystem explodes.
And a higher TVL is used by analysts to justify a higher fundamental value for the governance token.
For WLFI, correct. The price of WLFI is no longer just speculation. It's backed by the massive, legally mandated flow of capital through its sister token. You use the power of the presidency to pump the value of your family's primary asset.
And this was happening at the same time as the executive order for a U.S. strategic Bitcoin reserve, right? That has to be connected.
Oh, absolutely. That was the other side of the coin. The Genius Act domesticates the dollar side of crypto. The Bitcoin reserve legitimizes the asset side. It sends a massive signal to every sovereign wealth fund and central bank on the planet. The United States is treating Bitcoin as a strategic reserve asset, just like gold.
Which opens the door for them to get involved.
It doesn't just open the door, it rolls out the red carpet. And that's where the report transitions into what it calls the geopolitical shift. Because now we're not just talking about American hedge funds, we are talking about foreign capital.
And this is where that massive unreleased supply of WLFI tokens becomes more than just an asset.
It becomes a tool of foreign policy. It acts as a magnet for foreign capital that was seeking political favor. The report highlights two extremely troubling case studies in what it bluntly calls checkbook statecraft.
Let's start with the first one. Justin Sun.
Justin Sun, the founder of the Tron crypto network, a very flamboyant and controversial figure in the space for many years. He made a very public, very loud investment of $30 million into World Liberty Financial.
And the context here is critical. At the time of his investment, Sun was not exactly on good terms with U.S. regulators.
Not at all. He was under active and significant scrutiny from the SEC, among other agencies, for a variety of alleged securities violations. He was in their crosshairs.
But then, after the investment and after the inauguration,
the reports, confirmed by several sources in the document, indicate that the SEC investigation was quietly shelved, dropped.
And he wasn't trying to hide the connection, was he?
That's the most brazen part. He tweeted about it. The report has screenshots. He tweeted about wanting to unlock his founder tokens and buying more WLFI to curry favor. He said the quiet part out loud. He drew a direct line between his capital investment and his desire for a favorable political outcome.
But why do it that way? Why not just make a massive donation to a super PAC? Isn't that the traditional way to buy influence?
Because a super PAC has disclosure laws, it has donation limits, and it's explicitly political. Buying a token on the open market, that's a business transaction. That's an investment in promising technology. It gives everyone involved a layer of plausible deniability.
I just like the tech.
It's the ultimate get-out-of-jail-free card. How can you prove it's a bribe when they can just claim to be a savvy investor? But the second case study is even bigger. It involves Abu Dhabi.
Sovereign state.
A sovereign state-affiliated investment firm bought $2 billion worth of the USD1 stablecoin, a $2 billion injection of liquidity into the system.
And what was the quid pro quo in that deal?
The report alleges it was part of a larger, complex deal involving Abu Dhabi taking a stake in the crypto exchange Binance, a deal that culminated in a presidential pardon for Binance's founder, Changpeng Zhao, or CZ, who had been facing serious federal charges.
So let's connect the dots. You have foreign actors, some of them actual states, who are under U.S. regulatory or legal pressure.
Yes.
They inject billions of dollars of liquidity into the Trump family's financial ecosystem, either by buying the stablecoin or the governance token.
Providing the desperately needed exit liquidity for that $5 billion paper fortune.
And in return, the administration provides regulatory relief, dropped investigations, or even presidential pardons.
The WLFI ecosystem becomes, as the report puts it, a settlement layer for geopolitical deals. It's not just a bank anymore. It's a diplomatic back channel where the transaction fees are paid directly to the president's family.
It perfectly aligns the financial incentives of the U.S. executive branch with the portfolio managers of adversarial or quasi-adversarial foreign states.
It creates a kind of mutually assured financial destruction pact. If the WLFI token fails, the foreign state's investment gets wiped out. If the foreign state dumps their tokens, the president's family's net worth collapses. Their fates are intertwined.
Which leads us inevitably to the section of the report they call the greenback nightmare. Because if you follow this to its logical conclusion, what happens to the actual U.S. dollar?
This is the systemic risk. This is the part that moves beyond just, ethics or conflicts of interest and into a potential threat to global financial stability.
Right. We've had the Federal Reserve for over a century. And people can love it or hate it, but it operates under a specific legal framework, a dual mandate.
Maximum employment and stable prices. For all its flaws, the Fed's stated purpose is to protect the broader U.S. economy. It answers theoretically to Congress.
World Liberty Financial, however, is what the report calls a shadow bank. It has no such mandate.
Its only mandate is to protect its own liquidity and maximize the value of the insiders' WLFI tokens. Full stop.
So let's play this out. Imagine a crisis hits. Another 2008-style financial meltdown. What happens?
In 2008, the Federal Reserve stepped in. It acted as the lender of last resort. It injected trillions of dollars of liquidity into the system to prevent a total collapse. It printed money to stop the bleeding.
And what would a shadow bank like World Liberty Financial do?
It would act on pure profit motive. In a crisis, its incentive might be to restrict liquidity to protect its own reserves. It might freeze redemptions to prevent a bank run on USD1. It would save itself, not the system.
And if the President of the United States controls the dominant digital dollar infrastructure, he effectively controls a global financial off-switch.
That is the ultimate risk. And unlike the Fed chair, he isn't answerable to Congress in the same way. In the world of DeFi, you're answerable to the token holders, but who are the token holders?
Which brings us to the final and maybe most cynical piece of this puzzle, the part the report calls the second vote.
This was the part that, for me, just laid the whole game bare. The entire promise of crypto and DeFi was built on this idea of decentralized governance.
Power to the people. The community decides the future of the protocol through voting with their tokens.
Exactly. And the gold paper makes a big deal of this. Remember the lockbox? The 80% of public tokens and all the founder tokens that are locked up?
Yes.
The promise is, don't worry, the community will get to vote on when to unlock that supply. It sounds democratic. It sounds fair.
But the devil is in the blockchain data.
The devil is always in the on-chain data. The report's analysts did a forensic breakdown of a major governance vote that just happened this month, January 2026.
This was the vote to allocate $120 million from the project and treasury to create new incentives for using USD1, a massive use of funds.
A huge strategic decision. And when they analyzed the voting wallets, what did they find? Was it tens of thousands of smallholders participating in democracy?
No. They found that the top 9 wallets controlled nearly 60% of the total voting power.
9 wallets. And the single largest voting wallet, with 18.7% of the power, was an address directly linked back to the initial founder allocation.
So when they say the community will vote,
They mean themselves. They mean the insiders and a handful of their largest investors. The average user, the person holding a few $1,000s of WLFI, their vote is a rounding error. It's meaningless.
it's the illusion of governance.
It's a trap. The insiders retain complete control over when to unlock that $5 billion in supply.
So let's put it all together. They have this massive illiquid position. They can't sell it yet.
So their entire strategy becomes clear. Step 1, keep the supply locked to maintain the high paper valuation. Step 2, use the Genius Act to force U.S. institutions to provide liquidity. Step 3, use checkbook statecraft to bring in foreign sovereign wealth as additional liquidity.
Manufacture demand on a global scale. Drive the price up even higher.
And then, and only then, when the market is frothy, when there are trillions of dollars in the system from pension funds and sovereign wealth funds who are legally obligated to be there.
Then the community, those 9 wallets, will vote to finally open the lockbox,
And the insiders will finally be able to exit their $5 billion positions.
selling their tokens into the very liquidity that they, through their control of the U.S. government, manufactured.
It is a slow-motion, state-sanctioned exit scam on a scale that is difficult to comprehend.
It's just, when you lay it out piece by piece like that, it's overwhelming. It's so much bigger than the headline, Trump launches a crypto coin. It's a fundamental restructuring of the relationship between the state and the market.
It's a closed loop, a perfect circle, a sovereign chain. The legislation pumps the token. The token enriches the family. The family controls the legislation.
So let's bring this back to the listener. What does this mean for the person who, maybe they like the president, they support his policies, and they bought a few hundred or a few $1,000s worth of WLFI because they think it's going to the moon?
It means you have to understand your role in this ecosystem. You think you are buying a utility token. You think you're investing in the future of finance. You think you're getting in early on the next big thing.
But in reality,
You are the exit liquidity. You are funding the final step in the transition of the US dollar into a privatized, family-owned asset. Your purchase is a vote of confidence that is being validated not by free market adoption, but by the full faith and credit of the regulatory state.
we've covered a staggering amount of ground. From the 2021 pivot to the gold paper, the fee structure versus the equity, the illusion of that FDV, and the terrifying mechanics of the Genius Act and the Strategic Reserve.
And the geopolitical angle.
Yeah.
Using this token as a chip for pardons and regulatory favors, it's a new paradigm for foreign influence.
It really is. We always try to end these deep dives with one final provocative thought, a question for you to mull over.
I think for this episode, it has to come back to that vote, that illusion of control.
The gold paper, the website, all the marketing.
Yeah.
It all promises that a second vote is coming. The big one. The vote to finally unlock that $5 billion treasure chest.
We know from the data that the insiders hold all the keys. We know the liquidity is being manufactured by federal law and foreign capital injections.
So the final question is this. When that second vote finally happens, when the motion is formally put on the blockchain to unlock $5 billion of wealth for the founders, who do you think will actually be counting the ballots?
And maybe the more important question is, when the music stops, who's going to be left holding the bag? you.